Hey everybody, welcome to your week in review for the week of July 5th, 2022. Our Monday was on a Tuesday this week because most great Mondays are on a Tuesday. We had a strong open to the bond market, being up 20 basis points early. They were a little shaky in the overnight, but when stocks opened up, it helped bonds. The U.S. equity futures tumbled over concerns about the recession, even in spite of some optimism of easing trade tariffs with China. New talks have opened up between the U.S. and China on reducing some tariffs on goods to and from China. However, the fears over a pending recession have far outweighed that, and stocks were down on the morning. The Atlanta Fed has revised its quarter 2 GDP estimate from zero flat growth to minus 2.1%, which is particularly bad following a negative 1.6 in the first quarter. Having 2 quarters of negative GDP growth is one of the ingredients that leads to a recession. However, that is ultimately the call of the National Bureau of Economic Research. Their definition is a significant economic decline lasting more than a few months. The 3 main criteria are the depth, diffusion, and duration of the economic stagnation. This is also typically a delayed announcement, so normally they will call the recession well after it's already felt. CoreLogic home price report showed housing prices are up 1.8% in May, which is 20.2% year over year, so it hasn't really impacted housing yet. This is also jobs week, so all eyes are on the job reports. Street is looking for 270,000 jobs and for an unemployment rate to stay at 3.6%. We'll also get the ISM services report, which will be a bellwether for the state of the economy. MBS are trying out the 50-day average as a ceiling, so it's trying to break through that. On the day, we did end up going through the 50-day moving average, which would create a new floor that unfortunately wouldn't last for very long. Barry Habib had some great points earlier today in his articles. The world runs on credit. For every $1 of cash in circulation, there is $17 worth of credit. Raising rates increases the cost of that credit, so companies, people will borrow less, though that means they spend less. That's how we cool down an economy. Also, some real stats on housing is right now it's reporting that there are roughly 1 million units of inventory available. However, 600,000 of those are under contract, and there are about 30,000 worth of built new homes for sale. And if someone lists a $500,000 house for $550,000 to see who bites, then lowers the price to $500,000, that really isn't a price reduction. So there's some things to keep in mind when we're hearing the news stories about the housing market. We also got a new post from our sponsor at WellThatMakesSense.com, which is a great blog to give you new ideas to get through life. This is another in the series of How to Get Rich by Naval Ravikant, where he says, in the future, anybody that wants to work for themselves will be able to work for themselves. They just might have to make a little bit of sacrifice. Which brings us into Wednesday, July 6th, 2022. Tough open for bonds being down 23 basis points, which slid to 34 basis points, which then got worse as the day went on. A renewed spike in COVID cases in China, as well as a worsening gas prices in Europe, is signaling a world slowdown, so it's looking more and more like a global recession is coming through. Also, the U.S. yield curve remains inverted. The 10-2 spread is minus 3 basis points, with investors waiting to hear the minutes from the Fed meeting today, which did not help anything else at all. MBS dipped below the 50-day moving average and bounced off of the floor at 100.603, which was our floor pretty much all last week. MBS and Treasuries were already at their lowest point of the day before the Fed minutes. The minutes themselves contained essentially nothing new. However, the market reacted pretty heavily by selling off by about another 25-30 basis points after the fact. In the Fed minutes, we saw that participants judged the rate increase of 50 or 75 basis points would likely be appropriate for the July meeting. Many participants judged that there was a significant risk of higher inflation could become entrenched if the public questions Fed's resolve. And essentially all around, they said that they are more worried about inflation being high than going into a recession. On the day, we ended up being down 64 basis points on the MBS. The Treasury went up to 2.93, which was a 12 basis point increase. Saw pretty bad selling through the whole yield spread. And once again, we went back below that 100.603. So we have this pretty defined range right around that 100.603 that's held up for a couple of weeks now. So we'll have to keep an eye and see how they open tomorrow. Also, word on the street is that Sprout Mortgage is closing. I'm not sure if it's just their retail operations are closing in its entirety. Have to see if there's some more news that comes from that. And then we had Thursday, July 7th, or some people call it Friday Eve. Well, I call it that at least. Markets opened up pretty flat all in all. Stocks were up 37 points on the S&P pretty early, which is a small gain considering the level of the index. Bonds were down 8 basis points, which compared to the swings we've had lately is pretty much flat. Initial jobless claims increased by 4,000 to 235,000, which is still a good number. Median estimate was for 230,000. Continuing claims rose to 1.38 million. All in all, these are pretty good job numbers. However, a lot of people feel like it's going to be downhill from here in terms of employment, which is feeding into the contrary market moves where half of the people seem like they're super concerned about recession and half the people seem like they're super concerned about inflation. So some people are seeing this as a sign that the moves to quell inflation are working and recession is on its way. This is ahead of the jobs report, which is coming on Friday. We aren't getting the ADP report this week because they've actually suspended releasing that until they can retool it to make it more accurate, which they're estimating to be somewhere around November. We did, however, get the JOLTS report, which might take on new meaning without the ADP report. That stands for Job Openings and Labor Turnover. This report showed that the total number of job openings dropped by 400,000. Though this is down from, a really high level. So we basically went from 11.7 million down to 11.3 million. Could be an early sign that the economy is slowing. The BLS jobs report is coming on Friday, and as of this point, the market was looking for 240,000 total job creations. Like we said, the bond market all in all was pretty flat. The MBSs were pretty flat on the day, at least on the MBS side of things. The Treasury was up 9 ticks right at that 3.0000 level, which was a pretty strong floor that we were holding on to for quite a while. MBS is basically running that narrow range where it is going between the 50-day moving average and the 25-day moving average, with that Fibonacci line of 100.603 right in the middle. That 100.603 has been the line we've been teeter-tottering above and below for over a month now. We'll have to see how things play out tomorrow after the jobs report to see if it can get back above that 50-day moving average and hold, which gives us a little bit of room to run for improvement. Also today, in the wake of Sprout closing, Angel Oak severely cut their LTVs on most of their programs. Hopefully the industry will see the failure of GMC and Sprout as just that, the failure of two possibly poorly ran companies, instead of a harbinger of bad things for the industry segment. We also got the final post in our series from How to Get Rich by Naval Ravikant. Basically, to summarize the entire series, is he's talking about ways that you can productize yourself. So taking your own unique skills and abilities and turning that into a product where the more people you add into the product, it doesn't require more work or more money from you. Definitely check it out on www.WellThatMakesSense.com. And then we had Friday, Jobs Friday. Job report came in way better than expected, and the bond market did not like it. The MBSs were down 20 basis points early, and the 10-year Treasury was up 4 basis points real early in the morning, ending the day down 34 basis points. The Treasury up 7 basis points. Surprisingly, the S&P didn't like it either, which is kind of weird. So we have to look into the numbers. The BLS jobs report showed 372,000 jobs created in June, which is roughly the amount of edits I'm probably going to have to do to explain all the inconsistencies in this report. If you don't believe me, this is my third try doing this video. Either which way you look at it, it's way better than the 230,000 to 250,000 jobs that was expected. The April and May reports were revised lower by 74,000. Headline numbers way strong. However, the household survey actually showed 315,000 job losses. However, the other half of the survey, which is statistics gathered throughout the economy, netted out to the 372,000 gains, all because of the weirdness in the numbers of the unemployment rate, which actually stayed steady after all of that at 3.6%, mostly because it's a dumb stat. The labor force participation rate went from 62.3% to 62.2%. This is underreported and under-talked about. Only 62% of our citizens are out and working and looking for jobs. The real unemployment rate is really way higher than 3.6%. Why, you might ask? Because you're smart? Because the normal quoted reported 3.6 unemployment rate doesn't count 6 million unemployed people who are unemployed because they aren't looking. They just exclude that from the number. The actual U6 number, which adds these people back in, decreased slightly from 7.1% to 7.6%. Earnings were up 4.2% year over year. Welcome to America in 2022. If you generate enough stats, you'll find one to support your argument. I guess the gauge we've been watching for the last 2 weeks moved from recession bad to inflation bad, for today's anyway. With the strong jobs report, it's all systems go for the Fed to do a 3/4 point rate hike in the next meeting. Jobs are staying strong, economy still hot, 3/4 point is coming in the next meeting. MBSs are still battling that 25-day moving average as the floor. We see where things went, it dipped well below it today, before ending out still below it. We definitely don't want to fall down to the next support line, which is at 99.281, which is about a 3/4 point drop from where we're at. So we'll have to see how everything opens up next week. We also got some great information from Elliot Eisenberg over at econ70.com, home of laughs and graphs. This was something I wouldn't have known otherwise, so I wanted to share it with you. In early 1972, with the Fed funds rate at 3%, the Fed began raising rates to quash inflation. By the end of 73, the Fed funds rate exceeded 10%, and the economy entered into a deep recession. The Fed continued raising rates, ultimately pushing the Fed funds rate to 13% by June of 74. And thinking inflation was licked, began lowering rates to 5% by June of 75. The economy recovered, but inflation remained. This is the big thing that haunts Powell. So I thought that was some interesting insights. Another big news topic of the week is the closure of Sprout right on the heels of FGMC. So we had two pretty notable non-QM lenders fail this week. So it's going to be interesting to see how the market sees this. They're either going to see this as a testament to the economy or just two companies that fail. Two things I think are important to note out is neither of them were really very good at what they did. To me, FGMC was always kind of like the furniture store out in the strip mall by the mall, where every 18 months they hung a under new management, try us out sign. Regime changes, pivoting from reno, conforming, non-QM. Plus, I mean, a company that needs a cash infusion after the couple of months after the best 2 years in the history of the business doesn't seem like someplace that's ran very well. So kind of the same thing with Sprout. In Sprout, I talked to two people yesterday that did their own personal loans with Sprout, and they said it was nothing but brain damage. It's fairly evident because, I mean, Sprout allegedly didn't pay their employees the day after they announced that they were closing. So they announced they're going to close and didn't pay the payroll that was due the following day, allegedly. All of this stuff's allegedly. FGMC allegedly wasn't that good, but allegedly wasn't very good at closing loans. There's also some news reports where allegedly FGMC got served with a harassment, discrimination, bro culture suit the day before they closed. Also, allegedly, Sprout was being sued by a lender for not buying loans, something like a $5 million suit. So those things could be factoring into this as well. Hope everybody just doesn't write off the entire segment of the industry. The other thing that I think is personal in my mind is we have to stop assuming that companies are good just because the people that run them made a ton of money the last couple of years. I've been saying this for a while. There's been a lot of people running downhill the last 3 years thinking they're thoroughbreds. Now it's time to get up the other side of the canyon. So I guess it's time for us mules, jackasses, to shine. Another great perspective I saw in an article, I think it was sent out by Dave Savage, but it was a quote from Sue Woodard. who is over at Total Expert and very prominent on social media. I've seen this said before, but if we hit the projected forecast of 2.6 trillion loans this year, it's obviously a big downturn from the 4.2 trillion we did the year before, but it's still the third best year on record of the last 15 years. So there's plenty of money to be made out there. So now we got to look at next week. We got several things coming. So we have a 3-year auction on Monday. We have a 10-year note auction, which is a market mover, on Tuesday. Wednesday, we start getting the big guns, CPI numbers coming in, and a 30-year bond auction, hot tail of those numbers. We get producer index on Thursday, inflation outlook on Friday. So expect a volatile week next week. I hope you have a great weekend. Check out our sponsor, WellThatMakesSense.com, if you want some good thoughts, some good insights, and some things you can use to help make more money. Have a great weekend.